So, chapter 8 is all about relevant costs for short term decision making. So, we're going to be looking at information to make decisions for impacting the short term. So, there's a lot of different decisions that a company has available to make. And what we're trying to do is sort through all of the information that we have available to us and just focus on the pieces that are relevant to the decision at hand, whatever the decision may be. So we're going to be looking at make or buy decisions. We're going to look at whether or not they should keep or drop a segment, whether they should continue processing or sell at a certain point, figuring out what's most profitable for the company. The thing with this chapter is that you're going to be given a lot of information, a lot of numbers, and you need to be able to go through that set of information that's given and eliminate a whole bunch of information. Because as managers, you're privy to everything the company has. You know the costs, you know the revenues, but you need to figure out what is important and relevant to the decision that's at hand that you're focusing on right now. So we're going to go over some definitions that you may have seen in chapter 2. First one is relevant costs and benefits. Relevant costs and benefits are those costs and benefits that differ between alternatives. So you have two different decisions at hand, and these are costs or benefits that are included in one decision but not the other. Relevant costs and benefits are the only things that are important to the decision that you're making. When we think about a relevant benefit could be a decrease in a specific cost, right? Because reduction of costs is a benefit. It's going to increase your bottom line. Or it would be an increase in revenue or contribution margin. An avoidable cost is a type of relevant cost. An avoidable cost is a cost that can be eliminated in whole or in part by choosing one alternative over another. It is relevant to the decisions at hand because in one scenario, we can remove this cost. In another scenario, we would incur this cost. So it's relevant to that decision at hand. So it might be a reduction in raw material costs or direct material costs or direct labor costs. If we're able to reduce the cost, it's an avoidable cost. Unavoidable costs are always irrelevant. So a cost that we're going to incur regardless if we decide go with decision 1 or decision 2 doesn't matter. It's irrelevant. You're going to incur it regardless if you go with decision 1 or decision 2. So you ignore that cost. It's unavoidable. There are two costs that are never relevant to a decision. Sunk costs are costs that have been incurred in the past. You already spent the money. It's gone. And it doesn't and it shouldn't impact your decision at hand. You incurred it in the past, doesn't matter going forward. So when you purchase a vehicle, the amount that you pay for that vehicle is a sunk cost, right? Because as soon as you drive that car off of the lot, the value is reduced. And when you're thinking about selling that car, how much you paid for it is really irrelevant. It's a sunk cost. A cost that we're used to seeing in the income statement that is a sunk cost is depreciation expense. Remember, depreciation expense is that cost of those fixed assets spread out over the useful life of the assets. So we're spreading out that sunk cost over a period of time. So whenever you see depreciation expense, you know it is a sunk cost. You ignore it. You cross it out immediately. The other costs that's never relevant are future costs that do not differ between alternatives. So if you're going to incur a cost under each scenario that you're looking at, it's considered irrelevant and you need to eliminate it from your analysis. When you're going through the decision-making process, the first thing you need to figure out is what's the decision? What decision are we making? The second is to eliminate those costs that are irrelevant. And then the last part is to focus on those costs that are relevant so you can make a decision. But you have to go through the process of getting rid of those irrelevant costs and benefits, or you're just going to have a lot of information and it's likely you'll make the wrong decision. So what I want you to first do is look at this relevant cost analysis here, this example, read through the paragraph and figure out whether each of these items is relevant or irrelevant to that decision. Figure out what the decision is first. So I'll give you a few minutes to do that. So management is considering purchasing a Model B300 machine to use in addition to the company's present Model B100 machine. This will increase the company's production and sales. The increase in volume will be large enough to require increases in fixed selling expenses and in general administrative overhead, but not in the fixed manufacturing overhead. Indicate whether each cost is relevant or irrelevant. What's the decision that they're making here?
Whether or not
whether to buy a new machine, right?
Yeah.
Are they selling their other machine?
No.
Okay. Okay. So, sales revenue. Is it relevant to this decision? Will there be a change to sales revenue?
Yes.
Yes. They're going to increase sales, right? Increase in volume. Increase in sales. So we know that sales revenue is relevant because you're going to see an increase in your sales revenue. So that increase is relevant to the decision. Direct materials.
Yes.
Why?
Because of with the increase in the volume for the machine, are we going to have more materials for that machine?
Correct. So you're going to have an increase in production, increase in volume of sales. So you're going to see an increase in direct material costs, which is a variable cost. So if volume increases, you're going to see an increase in direct material costs. Direct labor.
Yes.
Yes, direct labor costs are also going to increase because, again, it's a variable cost. Production is increasing, so direct labor costs are going to increase. Variable manufacturing overhead.
Yes.
Yes, again, production is increasing, so you're going to see an increase in variable manufacturing overhead. Depreciation of model B100.
Not relevant.
Irrelevant. Sunk cost. Book value of model B100. What is book value?
Isn't that a
Isn't that the price we like the price we paid for it or the price it's worth now?
It's the value of the asset to our books. So it's a calculation cost of the fixed asset minus accumulated depreciation, how much depreciation expense we've taken on the asset so far, gives us book value.
I mean, but they're not selling it, so why would we?
Even if they were
Consider it.
selling it, book value is irrelevant. It's an accrual basis number. It's not cash basis. It is a sunk cost. If you look at it, cost of the fixed asset is a sunk cost. Accumulated depreciation is a spreading over of that sunk cost. So book value by default is a sunk cost.
Boom.
And the other reason is we're not selling B100, right?
Mm.
Keeping it.
No, we're not.
Disposal value of model B100. So cash
Irrelevant.
proceeds from selling the B100. It's irrelevant. We're not selling it. If we were selling the model B100, then this would be relevant. But this decision is not looking at the sale. It's looking at just adding an additional machine. Market value of model B300.
Relevant.
Relevant, absolutely. We have to pay for that equipment or that machine. So how much we have to pay is relevant. It's a cost that we're going to incur. Fixed manufacturing overhead.
Irrelevant.
What was that?
Irrelevant.
Irrelevant, yeah. There's no change to fixed manufacturing overhead. And it says it right here. Variable selling expense.
Mm.
Relevant.
It's relevant because you're going to have an increase in sales. So if you have an increase in sales, unless stated otherwise, your variable selling expenses will also increase because it's variable. So it's increasing. It is relevant. Fixed selling expenses.
Also relevant.
Relevant because it was explicitly stated. So with those fixed costs, if they don't say anything about the fixed cost changing, then it's implied that it's not changing. Unlike variable costs, where if variable costs, if they don't say anything, then it's implied that it is changing. Does that make sense? General
Yeah.
and administrative overhead.
Relevant.
Relevant, it tells you it's going to increase. So that was just an exercise to look through these. Now we're going to apply it to an actual problem. So we're going to look at a keep or drop analysis. And any questions on that before we move up? Okay.
No, thank you.
Okay, so with a keep or drop a segment, we're looking at potentially getting rid of a product line that we're offering, maybe a division that we have, perhaps not operating in a specific geographical location. So it's a big deal what we're thinking about. So we need to make sure that we're including the right information in our analysis. Basically, what we're trying to figure out is if we were to drop this segment, is it going to make the company more profitable overall? If it's not going to make the company more profitable overall to drop the segment, then we're going to keep it. So due to declining popularity of digital watches, Lavelle Company's digital watch line has not reported a profit for several years. Lavelle is considering discontinuing this product line. So here's the segmented income statement. So just the income statement for this one segment, their digital watch line. They gave it to us in the contribution income statement format, which is going to be the easiest way to look at it. So they have sales of 500,000, contribution margin of 300,000, 3 different types of variable expenses listed here. We have some fixed expenses totaling $400,000. And currently it looks like the company for this segment is operating at a loss of $100,000. An investigation has revealed that the fixed general factory overhead and fixed general administrative expenses will not be affected by dropping the digital watch line. Fixed general factory overhead and general administrative expenses assigned to this product would be reallocated to other product lines. The equipment used to manufacture the digital watch line has no alternative. So it can't be used anywhere else. So right here where they're talking about the fixed general factory overhead and the general administrative expenses, what is that telling you? If these costs are going to be incurred regardless if we have this digital watch line or not, what does it mean about those expenses?
It says they're fixed expenses.
Besides being fixed expenses, are these costs directly related to, remember the direct versus indirect topic of chapter 2? Are these direct costs of the digital watch line?
No, they're indirect costs.
They're indirect costs, right? So when we see this word allocated, we know that these costs are irrelevant. They're unavoidable. The company is going to incur them regardless if they keep the digital watch line or if they drop the digital watch line. Remember that a cost that does not differ between the alternatives is irrelevant to the decision. So right now, we know that we can eliminate the general factory overhead from our analysis, as well as the general administrative expenses. because we know that these are going to be absorbed by the company. These were just allocated out to each of the product lines that they offer. It's not incurred directly from this product line. What we have to do is figure out what's relevant and what's not of the remaining items, because not much was discussed below. So, is the sales relevant? Is it an avoidable cost or benefit? If we keep the digital watch line, will we have the sales revenue?
No. Oh, wait.
If
If we keep it,
If we keep it, will we have sales revenue from this product line?
yes.
It is relevant.
It is relevant. So if we keep it, we will have it. If we drop the segment, we won't earn it. So it is relevant. For variable costs, manufacturing costs, shipping costs, commissions, if we keep the segment, will we incur these costs?
Yes.
Yes. Right? Because it's variable in nature. If you have the sales, you're going to have these variable costs. If you drop the segment, will you incur these costs?
No.
No. So we know those are relevant. And by default, contribution margin is going to be relevant. The excess of sales after subtracting variable expenses. The salary of the line manager. So the manager in charge of this digital watch line. If you keep the segment, do you incur this cost?
Yes.
Yes. If you drop it, what happens?
No.
So is it relevant?
Yes.
It's absolutely relevant, because under one decision you'll have it and the other decision you won't. Depreciation of equipment,
Irrelevant.
irrelevant, because it's sunk. Advertising, direct advertising, so just specific advertising for this product line. If you keep the segment, will you continue advertising?
Yes.
Yes, it's implied because they didn't say anything. If you drop the segment, will you incur it?
No, it's relevant cost.
No, so it's definitely relevant. And then rent for the factory space. And we're saying that this factory is just the factory where they manufacture the facility or the watch line.
Relevant.
It's relevant. With a keeper drop analysis, you're going to be comparing the contribution margin lost to the fixed costs that you're avoiding. So the first thing that you're going to include is your contribution margin lost. So the benefit that you're giving up, because remember that your contribution margin is a benefit. It's the excess of sales after subtracting variable expenses. So if we decide to drop the segment, the company will give up $300,000 in contribution margin, and that is a negative. And we're comparing the contribution margin lost, our benefit that we're giving up, to those fixed costs that we're going to avoid. So if we drop this, These will completely go away or partially go away. So we have salary of the line manager. And if we spin off this product line, we won't have to pay him his salary of $90,000. So it's a reduction of costs that we'll have. If we drop the digital watch line, we will also not have to pay advertising for the digital watch line. Of 100,000. If we drop the digital watch line, we won't incur rent expense for the factory. 70,000. So the fixed costs that we're going to avoid total how much? These are the true costs, the true fixed costs that are directly related to this digital watch line, this division.
260,000.
260,000. So they have $260,000 in true costs for this division versus $300,000 in a benefit, which is contribution margin. And is it going to be a net advantage or disadvantage?
Disadvantage.
So net advantage or disadvantage? If we drop
Net.
the digital watch line. So is our bottom line going to increase or decrease if we drop the digital watch line? Currently, the digital watch line is contributing $300,000 in contribution margin for the company. Currently, they're incurring $260,000 in direct relevant costs. So if we were to drop the digital watch line, what would happen to the company's bottom line?
It would decrease by 40,000.
It would decrease by 40,000. So it's a net disadvantage if we drop the digital watch line.
Yes.
Because the contribution margin that we're contributing from this product line is greater than the costs that we're actually incurring related to this digital watch line. So even though it's showing like a net operating loss for this division, it's actually profitable by $40,000. Once you eliminate those costs that are shared costs, the general factory overhead and the general administrative expenses, as well as sunk costs. Those costs were actually making that product line look worse than it actually is. It's actually a profitable product line, and the company's bottom line would decrease by 40,000. So what would you recommend for this product line? You're going to keep the segment. And you can deduce something from this. if the contribution margin lost is greater than the fixed costs avoided, you're going to keep the segment. Because the company's bottom line would actually decrease if you dropped the segment. This is a profitable product line. If, however, the contribution margin lost is less than the fixed costs avoided, meaning that they're really not breaking even, they have more costs incurred than they actually have in benefits that are being earned from this, then you should drop the segment or consider dropping the segment. And the reason why I say consider dropping the segment, because there are qualitative factors that may determine why a company would choose to continue offering a specific product, even if it's not profitable. Think about Costco and their hot dogs at their like deli or whatever, the walk-up counter. There's no way they're making a profit when they're selling them for that cheap. Their rotisserie chicken that they keep at $5 or $4.99, whatever it is for a whole chicken. If you look at Sprouts or Bonds, Ralph's, whatever, they're selling it for $8, $7, $8 per chicken. They're not making a profit on those, but they know that by offering that at a loss and by being consistent with that price, people are coming in the door and they're spending more money. So in the long run, it's actually more profitable for them. Right? So you have to think about those qualitative factors in addition to the quantitative side of it. You have to look at the whole picture and the impact of everything on the company. Okay, we're going to take a quick break here because I need one. I can't sit for very long anymore. It's not very comfortable. So after the break, we'll do a make or buy decision. Do you guys have any questions before we take a break?
No, all makes sense.
Okay, good. Come back by 1:35 then. Okay, so the next decision we're going to look at is a make or buy decision. So these decisions are going to be useful for companies that are maybe creating all of their parts in-house for production purposes. And perhaps they're maybe walking away from offers that could be coming through from outside sources. So with a make or buy decision, it's deciding whether or not it's cheaper for the company to continue making a component piece in-house or purchasing it from an outside supplier. So Essex Company manufactures part 4A that is used in one of its products. The unit product cost of this part is $30. So it includes all of these costs. So this is the internal cost to create part 4A. The special equipment used to manufacture part 4A has no resale value. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by the decision. The $30 unit product cost is based on 20,000 parts produced each year. So we are going to include that over here. In our analysis. An outside supplier has offered to provide the 20,000 parts at a cost of $25 per part. So right now, if you were just to look at the unit product cost of $30 versus $25, it appears like it's cheaper to buy. this part, correct? Off the when you first look
Yes.
at it, right? So if this came in, they would probably think, oh, this is a pretty good offer. Maybe we shouldn't be making it in-house. But what do we know about some of these costs? Some of these costs are irrelevant to the decision. They're unavoidable costs or they're sunk costs. So we need to go through and figure out whether or not these costs are relevant to the decision at hand. So what costs are relevant, what costs are not relevant. Direct material costs, will we incur it if we make the part in-house?
Yes.
Yes.
Yeah. Will we incur this cost if we buy it?
No.
No.
No, so it is going to be relevant. It's an avoidable cost. Direct labor.
Yes.
Yes, we incur it if we make the part in-house. We won't incur it if we buy it. Variable overhead.
Yes.
Same
Or-
reason. We incur it if we make the part in-house. We won't incur this cost if we buy it. Depreciation of special equipment.
Irrelevant.
Irrelevant. It's a sunk cost.
It's a sunk cost. Supervisor's salaries. Supervisor's salary.
You must pay him. Yes.
You have to pay him if you make it, but will you pay him if you don't make the part in-house?
No.
No, so is it relevant?
Yes.
Yes. General factory overhead.
Irrelevant. It is unaffected by this decision.
So it's irrelevant, and the reason being is because it's unaffected. They're going to incur this cost regardless if they make the part in-house or if they buy it. So it's a shared cost, an allocated cost. So we want to figure out the total benefit of either making or buying this part. So we're going to go through and list out the costs. So direct material, of $9 per part. And we can multiply it times 20 parts at this point, or we can just do it at the end after we total it up. Direct labor is relevant. We incur it if we make the part in-house, but not if we buy it. $5 per part. Variable overhead is relevant, $1 per part. So notice those variable costs are relevant unless stated otherwise. Supervisor's salary. We need him if we are creating the part in-house. If we're not creating the part, then his job would be eliminated. So the cost per part to make is a total of what?
17.
$17.
Per part.
$17 per part times the 20,000 parts that is our annual need. So total cost to make is
340,000.
Correct. 340,000. On the buy side, we have the cost to buy, right? From supplier. And per part, it's $25, right? That's what our quote was. Times 20,000 parts. And at this point, you know, just by looking at the unit cost, that it's going to be more beneficial to do what?
Make it in-house.
Make it in-house, because it costs us $8 less per unit to make. Total cost to buy,
Was it 500,000?
500,000. So when you're figuring out the answer, you would say the net advantage to make part 4A, the difference between the 500,000 cost and the 340,000 to make, which would be $160,000. So it's clearly cheaper to make the part. You would tell the company to continue making the part in-house, but at least they know the true cost to make it in-house. So if a different supplier comes with a lower price, then they can take advantage of that in the future. Or if perhaps something changes with their cost structure and it goes above and beyond that $25 per part, then they can take advantage of that. Does this one make sense?
Yes.
We're going to add an extra element to it. So that was just a straight one where you didn't really have any other opportunities or potential opportunities out there. But we need to consider the opportunity cost of another potential benefit that we could be having if we were able to outsource our production. So an opportunity cost, you may be familiar with that term from economics, right? From an accounting perspective, especially from financial accounting, it's not something that we find in our accounting records because it's not an amount that we actually earn at this point in time. An opportunity cost is a benefit that's given up by pursuing one decision over another. So if you're deciding to go to school full-time versus working full-time, right? You're giving up that salary that you could be earning by going to school. So it's a benefit that you're giving up by choosing that one opportunity over another. With the opportunity cost, it always impacts the make side of a make or buy decision. Because with the make side, we're deciding whether or not to continue making this part in-house, and we're giving up that potential revenue or potential benefit that we could be earning from producing some other part, renting out the facility to another business. So we have to include that as an additional cost on the make side. It's going to increase the cost basis on the make side. So it may be more relevant or more beneficial for a company to buy than to make if there is an opportunity cost involved. So we're going to look at an example. Royal Company manufactures 20,000 units of part R3. So we're going to be looking at 20,000 units. And right now it looks like the total cost to produce each unit is $25. They have direct materials, direct labor, variable overhead, and then fixed overhead costs. An outside supplier has offered to sell 20,000 units of part R3 to Royal Company for $23.50. If Royal Company accepts this offer, the facilities now being used to make part R3 could be rented to another company for $150,000 per year. Okay, so if we outsource it, we can free up that space to rent out our facility. Also, Royal Company has determined that $6 of the fixed overhead being applied to part R3 would continue even if part R3 were purchased from the outside supplier. So, direct material costs. Are direct material costs relevant?
Yes.
Yes, you're going to incur it if you make, you won't incur it if you buy. Direct labor costs.
Relevant.
Relevant, right? You're going to incur it to make, not to buy. Variable overhead.
Relevant.
Relevant. You'll incur it to make, but not to buy. Fixed overhead. Can I just eliminate the whole amount?
No.
No. We have two amounts. We have $6 and we have the $4, right?
Mm-hmm.
Because they mentioned $6. Which of these amounts is relevant? Which of these?
The $4.
The $4, because this is avoidable. This is a shared cost, right? $6 was a shared cost. Unavoidable. They're going to incur it regardless if they make or buy the part. So first things first, let's figure out the unit product costs. So direct materials, $480 per unit. Direct labor, $7 per unit. Incur it to make, not to buy. Variable overhead costs of $3.20 per unit. And then fixed overhead costs of $4 per unit. So cost to make per unit is what?
$19.
$19 per unit times 20,000 units. So it looks like it costs us how much to make?
380,000.
380,000. Right now, if you look at the cost to make, $19 per unit versus the cost to buy, $23.50, you would automatically just jump and say, hey, it's cheaper to make. Let's not even finish our analysis, right? What are we forgetting in our analysis on the make side?
No, we have the opportunity to rent the facility.
Yeah. So rental revenue given up to make. Our opportunity cost, the benefit that we're going to give up to select this decision. $150,000 in revenue we're walking away from if we continue to make it in-house. So the true cost to make part R3 is the total of 380,000, the cost per unit, plus the opportunity cost, the benefit that we're giving up by choosing to make this in-house. How much is the total cost to make?
$530,000.
530,000. If we were to buy it, we're going to pay $23.50 per unit times 20,000 units. And how much are we going to pay in total?
$470,000.
470,000. With this opportunity cost, what's the net advantage to buy?
$60,000.
$60,000. So because they have that potential revenue that they can earn if they outsource it, even though they can make it technically cheaper in-house per unit, but once you incorporate that amount that they're giving up in revenue and lost revenue, the advantage is to buy it, outsource that so they can increase their bottom line by 60,000.
So they should buy it from another company.
Yep, they should absolutely buy it. It's way cheaper.
What were the reasons to not, like, say, even if there were advantages to selling out, but you said there's qualitative reasons why? What were they again?
For this one, it's not. There's less qualitative. This one, I mean, if I was the company, I would want a pretty solid person that I know that's going to be renting that facility, right? I want to be guaranteed that revenue in a way. Like, make sure that there's a contract, etc., before you start outsourcing it. because it is technically cheaper in-house to make. But when you include that revenue, like you could even reduce the rent and still zero out. So you could reduce the rent by 60,000. But over time, you're hoping to see that this is going to be more beneficial to outsource. The qualitative factor you might want to look at is the quality, right? The quality of the parts that you're getting from that outside supplier. Is it going to maintain the integrity of the product that you're making? Is the same level of quality that you're already currently making or better? Because you don't want to reduce your finished good product because you're using an inferior part from outsourcing. Is this supplier going to be able to meet your demand going forward? I think that that's probably where there were some issues, especially right now and in the earlier parts of this year, is that suppliers couldn't keep up with demand. So that's something to consider.
Oh,
So if there's any
that's
sort of
an
hiccup in
extreme
it,
scenario.
what was that?
Well, like that's an extreme scenario because like how often is a pandemic, you know?
Correct.
Or, I don't know.
It's definitely an extreme scenario, but if you're using a source that's maybe outside the country, then you have to consider the political aspects of that, right? Is it a country that we have additional tariffs with or previously had additional tariffs with, stuff like that. So you would just want to consider all of those factors when you're making the decision as to which supplier to go with. Is it from a source that's further away? So you have those additional shipping costs and the additional shipping time, et cetera. Can they keep up with demand, et cetera?
Makes sense. Thank you.
Okay. Do you guys want to take another like 5-minute break here? Stand up stretch break.
Yeah, it sounds good.
Thank you.
Right.
Okay, so another decision that managers could make is a special order. So whether or not to accept a one-time order from a customer, and we want to figure out how it's going to benefit the company. How is it going to increase the bottom line? We're not going to necessarily accept a special order that's going to decrease our bottom line. So when we're focusing on a special order, we're only focusing on incremental costs and benefits from the special order. This isn't a continued operation. It's not something that we're going to offer to all of our customers because we wouldn't be able to maintain our business by offering this special discounted price to other customers. But we need to figure out what truly are our costs to back into how much we're willing to accept as a selling price from our customer. So we're focusing on incremental costs and benefits, and those are costs and benefits that are going to increase from the special order. So we're not going to look at costs that are going to be unchanged, right? We're not going to look at any benefits that are going to be unchanged. It's only going to be focused on what's going to increase from the special order specifically. So Ch8 Inc. makes a single product whose normal selling price is $20 per unit. And what goes into determining that normal selling price? They're looking at all of the costs that they have for the company, for production, coming up with those costs, and then how much their margin they want or need to back into that normal selling price to maintain their normal operations. a foreign distributor offers to purchase 3,000 units for $10 per unit. So $10 per unit, that's a lot lower than their normal selling price. This is a one-time order that would not affect the company's regular business. So they can still earn their normal revenue, still earn their normal profit, and this additional profit if they accept the special order. So it has the potential to increase the company's bottom line. Annual capacity is 10,000 units, but Ch8 Inc. is currently producing and selling only 5,000 units. So are they operating well below their capacity?
Yes.
Yes,
Yeah.
meaning they're potentially walking away from profit by doing so. By accepting that special order of 3,000 units, are they still operating below their capacity?
Yes.
Yes.
Yes, so they're not putting any additional strain on the resources of the company. They have the potential of just increasing their bottom line. So with a special order, we have to figure out, okay, what is relevant to the decision? What costs are going to increase and what do we need to focus on? So right here, if you look, this is the income statement for the company. Currently, they have $100,000 in sales, 5,000 units sold at $20 per unit. They have variable costs noted, totaling 40,000, so contribution margin of 60,000. Then they have 2 fixed costs and net operating income of 12,000. So first things first is we need to figure out if this selling price that this guy is offering us, $10 per unit, is enough to cover the expenses that we're going to incur. So if we produce more units, what costs will increase?
Direct materials, direct labor, all of our variable.
All of our variable costs are going to increase, right? So that $40,000 is not a fixed cost. It's a total variable cost based on 5,000 units produced and sold. So we need to figure out the variable cost per unit. By taking our total variable costs divided by 5,000 units produced. Units produced. So when we produce and sell 5,000 units, we incur variable costs of 40,000. So on a per unit basis, our variable costs are
8,000 a unit.
$8.
Or $8.
Yeah, $8 per unit. For our fixed costs, manufacturing overhead or marketing, does it note anything above? Are we going to increase those costs at all? Is there any change to our fixed costs?
No.
No.
No. So unless stated otherwise, we're assuming that our fixed costs are not changing. It is within the relevant range of 10,000 units, so that makes sense. So typically with a special order, fixed costs are just going to be ignored unless they're noted as being changed. So what we're going to do is calculate how much our bottom line could increase from this job. So the increase in revenue or incremental revenue from the special order (3,000 units) are in that special order at a unit selling price of $10 per unit. So our revenue is going to increase by $30,000. We're also going to see an increase in costs, right? Specifically in this case, variable costs. 3,000 units in the special order at a cost of $8 per unit. So 24,000. Increase in revenue compared to an increase in costs. We're just going to net it. So we're going to see an increase in operating income or a profit of $6,000. So even though that selling price that he's offering is substantially lower than our normal selling price, it's still able to cover our extra costs that we're incurring and make a profit for the company. So with special orders, the normal selling price is typically irrelevant. And fixed costs are also typically irrelevant unless they change. And it would just be the increase in those costs. Does that make sense?
Yeah.
Okay. The next
So we
topic.
should then? We should take the offer then?
Absolutely, yeah. You would accept it. You have capacity. If you were to walk away from this, you would just be losing profit.
Okay.
And this is assuming that none of your other clients would know about this. Obviously, they probably would be upset if you did that, but it is a project that you would want to accept. You have capacity to accept it. If you didn't have excess capacity, it wouldn't be worth it. But since you do have excess capacity, you're willing to accept a lower selling price. Okay, this next topic is a lot more in depth. It's going to be looking at constrained resources. And I think that it would be beneficial to you to get started on your homework for this chapter for those three topics. So I'm going to release you right now.